It's been quite a disappointing day for the markets. We didn't take in the taper light announced by US Fed all that well. So let's bring on board our experts who will be joining in today on the show. We've got Rakesh Arora, who's the Managing Director and Head of Research at Macquarie Capital Securities. In addition to that, we'll also have Sandeep Bagle, founder and MD of AFTA Technical Advisory Services, as well as Varun Goel, who is the Head of Portfolio Management Services at Karvi Private Wealth, joining in.
Varun, let me come to you first. From the fundamental standpoint, do you think these concerns are legitimate that perhaps India could be a country which could face severe outflows going forward, because taper, however light it may be, has actually started, and on the receiving end could be currencies which are quite weak compared to the dollar, like Indian currency, and even emerging market equities could face a rough ride in the next couple of months. Varun?
Oh, well, I would not agree with that, with that point of view, because for the simple fact is that this is just the beginning of the tapering process, and let's understand what tapering means. Tapering is actually the reduction in the quantum of bond buying program. It is not really the selling back of the bonds which the Federal Reserve has already bought. So there is no way that the Federal Reserve is sucking liquidity back. It's just that they are increasing liquidity in the system, but at a smaller pace, and hence, there is no reason for us to have a disproportionate amount of fear that there is going to be a stampede to get out of India or any other emerging market. I think last time also what the correction that we saw in August and September was largely driven by panic reactions and sentimental reasons, and also the current account deficit situation that India was running at that point of time. Currently, we are in a much better position as far as CAD is concerned, so I don't see a lot of volatility on the rupee. As far as the equity market inflows are concerned, there could be a realignment in terms of how fresh inflows would come into which country, incremental inflows would come, but I don't think there's going to be outflows. We have seen last 5-6 years there has been continuous FI inflow into Indian equity, despite the growth rate getting slowed down from 9 to almost 4.5%, despite all the policy paralysis and all other concerns. So I believe FIs have taken a longer term call. They are here to stay, and I believe that FI inflows will continue, although they may continue at a smaller pace.
So clearly the crux of the matter is whether we see, further fresh inflows, and it's not so much about the outflows. So, Rakesh, give us a sense of what's your base case scenario now for the markets. The two key events which everyone was waiting for, the Fed move as well as the Reserve Bank of India, they're out of the way. So how would you be approaching the markets now?
See, while these two events were a big risk, and now they have actually come out much more milder than what was expected. So I think the focus will be back on fundamentals, which is improving. The GDP forecast for FY14 have inched up to 4.8 to 5% now. Only 3 months back, most economists were pointing to 4% or below. So economy has recovered, largely driven by exports and little bit help from rural demand. Going forward, I think the recovery will continue. We are forecasting GDP growth in FY15 to inch up to 5.4 to 5.5%. And once we have a stable government next year, probably the pace of recovery will pick up further in FY16. So with this kind of a recovery in GDP growth expected over the next 2 years, I think all reasons to buy market at all kind of dips.
Right, let's get a chart check going. Sandeep, on the Nifty, looking at how the day panned out, about a % cut coming in, how do you see the trade panning out for a compulsive Nifty trader?
Good evening, Ajay. I think we lost the advantage what we had in the morning, and had we built on it, that could have been a different story, but that is not to be. And as a Nifty trader, we are stuck in a range. I don't see 6100 being strongly broken and we go down to 5900. I don't have that view as of now. On the upside, 6230, 6250 will act as some kind of a resistance. So in this 100-120 points band, I really don't think the Nifty will move anywhere. It will consolidate, probably move sideways. And stock specific moves will happen like this. Today the IT space moved very strongly. Tomorrow it could be something else, day after something else. So it will be balancing out here and there. Some stocks will move up, some sectors will move up and down. That is what I feel. I don't see the Nifty breaking out of this range, at least for the next, probably till the end of the year.
Right. In fact, the big laggard in today's markets as well was the banking pack. Look at the cut that we saw on the bank Nifty as well. And, of course, the governor said that the liquidity situation for now, it seems pretty okay. And, you know, you've had the news coming in about State Bank of India also cutting rates, the home loan rates as well. In fact, they've also edged up the slab for the lower interest rate that's been moved up to 75 lakh rupees from the earlier 30 lakh rupees. In light of this, how do you see things shaping up, Varun, for the banking pack as a whole, and what's your position on a State Bank of India right now?
Well, we have turned positive on the public sector bank space after a very, very long time. In the last 1 month, we have been buying PSU banks on every dip. And I think for the banking sector as a whole, we would continue to use any adverse news flow to increase our position in the banking space. I believe as far as the worst is concerned for the balance sheet and asset quality, that is already out of the way. We believe that some of the private sector banks and selective public sector banks will continue to deliver decent earnings growth. The private sector banks, both large cap and mid cap names, have continued to deliver 15 to 20% kind of earnings growth, which we believe would continue. In the public sector space, we believe that the punishment for the asset quality has been far disproportionate. A lot of good quality public sector banks are trading at 0.5, 0.6 times FY15 book, and we clearly see value in that space. So we are definitely quite bullish, and we'll continue to buy banks at every dip.
Sandeep, let me come to you on Reliance Industries. If you look at the intraday graph of Reliance today, on the one hand, when Nifty and Bank Nifty were trading at the lowest point in the session, Reliance did give a pullback and almost broke into the green, though it did not sustain there. But there is surely signs that at lower levels buying seem to be emerging. How is the picture looking on Reliance charts?
Well, Ajay, I would agree with you. At a level of 835, 840, we seem to have found some kind of a support, and it will not be that easy to break that level on the downside. And in case it does, then we go down to probably 780 or so. But as of now, I would bet on the fact that it will not break 840 on the downside. On the upside, 875, 880 again remains a very strong resistance. So I would talk of that 40-50 point range. I don't see Reliance breaking 885, 890. I don't see it break 840. So in between that, a small move for 30-40 rupees is what I would say.
In fact, if we look at the other pocket that was very active today, and it has been off late, of course, is the IT pocket. It's a currency momentum, it's the defensive nature of the sector as well, which has propelled so many stocks higher, Varun. In just today's session, you have a Tech Mahindra, you have an HCL Tech. From the mid-cap side, you have a Persistent System. All these names are at fresh highs. Would you still be buying at current levels? Would you be comfortable with the valuations at which some of them are trading at?
Well, I think IT sector will continue to get re-rated, as we get into the earnings season. I believe that of all the sectors, that are present at this point of time, IT sector, provides a maximum opportunity for a valuation re-rating going forward. We believe that Indian IT has become far more competitive from a global perspective as compared to where it was in the beginning of the year, simply because of the 20% depreciation in rupee that we have seen. I believe that the revenue growth is going to be far stronger than what most analysts have been expecting. The quarter-on-quarter revenue growth for most of the Tier 1 IT companies was of the order of around 3 to 4% last quarter. This quarter again, we would expect revenue growth at least that much or maybe even higher. And if we look at the margin side, the clearly benefits of rupee depreciation will continue to come in. So IT space, I think, is definitely in a sweet spot. The return on equities, cash levels, balance sheet, there is comfort on all those things, and there is no reason why most of these companies can't trade at 20 times FY15 earnings. So I believe that there's still 10 to 15% upside possible in most of the Tier 1 IT names.
Let's get to Pharma then. That is one stock which is a consistent performer. Rakesh, what is your stand on Pharma? Because it's not only the top three like Sun, DRL and others which are leading, but now it's the smaller side, the mid-tier Pharma names like Biocon or Aurobindo. All of them have been starting to move pretty well. Where do you find their favor here?
See, Pharma is more of a stock-specific story. Obviously, rupee depreciation has helped everything, and there's been spate of inquiries through FDA. which has disrupted the momentum. But I think Pharma remains one of our core holding in the portfolio. And we are pushing for Sun Pharma, which has corrected meaningfully by around 10-15%. Then we are, very bullish on Ranbaxy and Glenmark. So these are the top 3 trades for us in pharma space. But obviously, investors who have stock-specific news can actually look at other ideas also.
Right, Sandeep, want to get a perspective from you on a couple of mid-cap names that were really active in today's session. Wockhardt, of course, has been a rather controversial stock, but you had a good 10% move coming in here. Even a BF Utilities, and what a multi-bagger it's become in the last few months alone.
Absolutely, Megha. If you ask me my view, yes, I am willing to buy a Wockhardt. The kind of pattern it has made in the daily and the weekly charts suggests a further move at a level of 415, 418. I would talk of a move beyond 460 or so. So very clear trade. And I think this is a stock which I would single out among the stock that you mentioned. I would take a trade for at least 7 to 8% upside from the current levels, though the long-term chart remains bearish. As a short-term trade, a certain yes.
Let's get you some more stocks that you should be watching out for tomorrow's trading session, and Navneet's here with them.
Well, in a volatile market like this, clearly dealers are being stock specific, so one long and one short call for the day. On the long side, dealers are suggesting to go long on Tech Mahindra. You saw the stock surging in today's trading session by about close to 4%. It also touched its 52-week high, and well, the dealers are expecting 3 to 4% more upside going forward for Tech Mahindra. On the future side also, we did see long positions being built up for this counter. On YTD basis, it has given spectacular returns of over 90%, and on the short side, it's Adani Enterprises, a counter which fell today by 1.5%. Dealers suggest going short on this counter, clearly because we've seen the stock surging about 70% in last 3 months, so they do see some kind of profit booking coming into this counter. Also, you saw the stock falling post a brokerage downgrade. You had UBS, which downgraded Adani Enterprises from buy to sell, giving it a target price of about 260 rupees, and the reason highlighted by the brokerage was the same. The stock has seen enough upside in the last 3 months, so they also see some kind of profit booking. The power business is weighing heavily on the consolidated entity of Adani Enterprises, and UBS prefers Adani Ports in the Adani Group stocks.
Thanks for that, Navneet. Varun, since you are constructive of markets right now, what are the particular sectors or themes you think investors should find value in over the next couple of months?
Well, we're definitely positive on IT and banking space. I think these two sectors constitute the core of the portfolio. Other than that, I think it's time to do some bottom-up stock picking. We are picking up, several mid-cap ideas in the pharma space, some auto ancillaries, and telecom as a space definitely looks attractive. We're particularly bullish on the telecom sector because we believe that the worst is now out of the way in terms of the pricing and competitive intensity. We believe that pricing will continue to move up. We see expansion in EBITDA margins for all the incumbent players, and that is definitely one space which will give very healthy earnings growth in the next couple of years.
Right, and Sandeep, what stocks would you pick out then for tomorrow's session?
Megha, buying Maruti, stop loss 1758, target 1825. A sell in Kotak Bank, stop loss 741, target 681.
Rakesh, would you look at IT as a core theme? Because within IT, would you stick to large cap, which are trading at an average multiple of 17 to 18 times 1 year forward? Or would you start looking at select mid cap, which also have promising growth, but are trading at a discount to these large cap peers?
Okay, so see, IT stocks have largely built in the gains of rupee depreciation. But remember that US economy is recovering, and that is why all this whole news of tapering, etc. is coming through. And in January results, we are expecting that IT companies should come out with clear guidance on how they are looking at the dollar revenue growth for next year. So that could be a positive trigger for these companies. I think looking at the whole Indian economy and the recovery, which is driven by exports, it is difficult to ignore IT at this juncture. And more so when the tapering risk is there and rupee can become weak again. So we think that one has to be, holding on to IT as a core of their portfolio. Now coming to stocks, our preference is more for TCS, etc., which are large cap companies, because the differential that you mentioned between say TCS 17 times and say HCL Tech 12 times has continued for last 1 decade, and we don't think that is going to narrow down anytime soon. So it doesn't really matter much, but in a volatile environment, I think TCS is a much better bet when you compare the risk rewards.
Okay, IT continues to be a favorite theme at Macquarie, and with that, gentlemen, we wrap it up right here. Thanks very much, Varun, Sandeep, as well as Rakesh, for joining in today on the show.